Hello, my friends. Welcome back to the channel. Philip here. This is Mindful Money Management. Today, we will talk about SVP, otherwise known as Silicon Valley Bank, the bank that failed last week within 44 hours. We will discuss the history of the bank, the business of the bank, why the bank failed, and should we as consumers be concerned about a wider issue within the banking sector. The bank is 40 years old. It was founded in the 1980 with a concentration on Silicon Valley startup. 98% of the bank's business involved being the bankers for small to medium-sized startup companies in the tech sector and in the medical field. The bank's focus meant it was highly leveraged in one sector of the banking industry. This was not smart by management. But was this the reason that the bank failed? It is, but it wasn't the only reason. If you've been following the stock market for the past 12 months, you should have noticed that the tech sector has been underperforming relative to the rest of the market. Companies such as Facebook, Google, Amazon, Alphabet, Snaps, and others have been losing market value for the past 12 months. As a result, many investors, in particularly venture capitalists, has begun to withdraw their financial investment in startup tech companies. The result was tech companies begin to withdraw the money they had stored or saved in Silicon Valley Bank to pay their employee wages. This increase in withdrawal placed Silicon Valley in a position where they needed to raise cash to keep up with the amount of money that was being removed from the bank. The bank attempted to sell, I think it's $21 billion in bonds and other assets in order to raise cash. Accounting for taxes and fees, it realized that they lost $1.8 billion, money that they needed to address the increased withdrawals. This loss triggered a further run on the bank by startup CEOs who wanted to remove their money from what they saw as a failing bank. The FDIC, or the Federal Deposit Insurance Corporation, and California regulators stepped in and took over the bank in an effort to prevent a widespread pandemic and a total collapse of the bank. But here is the question. How did trying to sell municipal bonds and treasury bonds and mortgage-backed securities trigger a run on the bank? Why did Silicon Valley Bank lost $1.8 billion when it was attempting to raise $2 billion in cash? That is the important question here. All banks invest in treasury bonds and in other government bonds. But the banks do not write down the value of these bonds as the years pass. Let's say, for example, they bought a bond in 2020 for $5. And in 2023, because of the increased interest rate, that $5 bond is now worth $4.50. On the bank's book, they still keep it as if it is valued at $5 instead of writing it down. This is done so as to not report any significant losses. The problem with this is, eventually, if the right conditions occur, such as it did in the Silicon Valley Bank case, you have to quickly raise capital, which means you have to sell those assets you have on your books. And when you take it to the The market will only give you what it values those bonds at or those assets at. This is what happened to Silicon Valley. Interest rates. Bonds tend to decrease in value as interest rates increases. Bonds tends to appreciate in value as interest rates decreases. If I bought a bond 2 years ago at a 2% fixed interest rate return, but currently the new bonds is offering a 3% interest rate return. Because the newer bond has a higher interest rate return when compared to the older ones loses value. It is no longer worth what it is stated to be worth on the books. And this is why older bonds is often worth less than newer issued bonds. Silicon Valley great error was not diversifying its business portfolio. It depended heavily on startup companies for its business. After all, that's the reason why the company started in the first place. But having been around for 40 something years, one would think they would have diversified into other areas. And when they did, they chose to buy government bonds or treasury-backed bonds or municipal bonds or mortgage-backed securities. The other issue Silicon Valley Bank faced was inexperience. For a long time, for almost a decade and a half, the company was operating in a no to low interest rate environment. As a result, when the Federal Reserve began to increase interest rate, they were not properly equipped to understand the long-term consequence of this rapidly increasing interest rate. So they sat there with these assets on their books that were undervalued by the market. Thus, when the situation arises where the startups begin to withdraw their money to make their payrolls, Silicon Valley Bank was forced to raise cash, only to realize that the assets that they had in their books was worth significantly less than what they thought. This is why the bank failed. A failure by management to quickly pivot their business idea to address a changing environment. And this is typical throughout the entire banking sector. As such, it is something that we as consumers need to be concerned about. If there is a situation where consumers think that their deposits are not secure, they will cause a run on that bank to get their money out. And the Federal Deposit Insurance Corporation only insures deposits up to $250,000. Anything after that, you have to wait until the FDIC liquidate the assets of the bank to recoup whatever money you have lost. And you're only going to recoup some of it. You're not going to recoup all of it. The government has stated that no taxpayer funds will be used to bail out the bank. At least this is what the president said. However, the Federal Reserve and the Treasury said that all deposits at the bank will be honored. That sounds weird. I know the FDIC, which is not financed by the taxpayers, but it is financed by the banks, do have a lot of money to cover losses. But I don't think the banks are going to look kindly on the fact that all the money that the FDIC have is being dedicated to bail out Silicon Valley Bank. There is a mixed message coming from the financial arm of the government and the executive branch. In some way or form, taxpayers, you and I, are going to end up picking up at least 40% of the bill for this bank. Even more annoying is that the top management of this bank sold their shares a week before the bank collapsed, indicating that they knew there was something wrong and they did not alert the public to it until they issued their quarterly report some 2 weeks ago. And that was the first indication that some investors, I think it was Modi's, identified there was a problem with the bank because they were highly leveraged in mortgage-backed securities, treasury bonds, municipal bonds, and other government bonds, while only 98% of their business was dedicated towards startup. What they should have done is have a great portion of their business dedicated towards ordinary depositors, such as you and I. This way, they would have had the risk shared around. They did not. So when the run on the bank started, thanks in part to Peter Thiel, they had no option but to try to sell assets to raise money, assets which they greatly undervalued. I hope this video clearly explained what happened at Silicon Valley Bank and why it failed. If you guys have any questions, suggestions, or anything you would like me to cover on this topic or any other topic, please leave it in the comment section below. My name is Philip. This is Mindful Money Management. Don't forget to like, subscribe, and turn your notification bell on. Until next time, spend wisely, my friends.